And lost the chat window. Chat. Okay. We have a small group tonight. It's only like 7 of us. So if y'all have any questions along the way, let me know. Because it's this chapter on budgets is not hard, but it's a lot to calculate when we start working through the budget and calculating everything. So if you need me to stop, just let me know. And if you need to ask questions, let me know. But we're gonna have to do some calculations to figure out some of the answers on the quick check. So we'll work through those together. And then we'll do the chapter 10 after that. And again, it's a lot of little calculations. So if you get confused, just let me know. I'm going to leave the screen this way so we can kind of bounce back and forth between the screens because they're going to give us, problem with numbers, and we'll have to refer back to that. So this chapter is on budgeting, and we're going to walk through the budget process for manufacturing company that's producing product, because this course focuses on that. But I just want to mention that most companies will do a budget, and so we actually are just kind of finalizing our budgeting process right now for next year. So we don't have a manufacturing company, we have real estate. But you want to be able to plan out what's happening for the next year, what income you expect, what do you, like in our case, we're looking to see what are the tenants' rents going to be, who are the new tenants that are coming in, what tenants are we expecting to leave, and what expenses are we going to have at the building, what type of repairs have to be done in excess of just regular normal maintenance. So do we have any capital improvements? So you're looking at that for a number of reasons. You want to know what that income is, what you're going to be spending as far as cash, because we're going to, have to know how much money do we have coming in, how much money do we have going out, so we can plan. So that's what we're going to be looking at tonight. Just keep in mind that, wherever you are, you're probably going to have a budgeting process. And so we're going to talk a little bit first about the budget itself and the process to create them, and why does an organization have a budget to begin with? So what is a budget? You probably know from some of your personal expenses, you have a budget, you know what income you have coming in. So you know what you have that you have to pay in your bills, what you have for food, what you have for entertaining. So, hopefully you're keeping a good budget so that way you can plan and know, how much can you spend, and hopefully you have a little bit of money you're able to save. So a budget's good to do in your personal life as well as in a business. So the budget is a detailed quantitative plan for acquiring and using financial and other resources over a specified forthcoming time period. So ordinarily we talk about that physical year, 12 months. It can be a calendar year, or it can be the physical year, but 12 months is usually a period. And so that's usually the budgeting process. But sometimes you may have an organization that will do a 12-month budget, and it just keeps rolling. So it's never ending, it's just perpetual, just keeps rolling continuously for 12 full months. So if we're looking at from 2020 to 2021, we have an operating budget right here that would ordinarily be that 12-month period of time for that calendar year. So we'd have that annual budget. That's how we do it. Where I work, and most places that I've worked, we've always done an annual budget. But again, keep in mind, they can have just, this would shift. So every 12, you're always looking at 12 months. Doesn't matter what month you're in, you're going to have 12 months. I would imagine that if you have an organization that's doing that type of budgeting, where you're looking at it, always on an ongoing basis, they probably have some kind of software that you're able to input the data into, and it helps you keep track of what's going on. So we have two key purposes. So planning, so that involves developing objectives and preparing various budgets to achieve the objectives. So when they say preparing various budgets, that just means within that budget itself. Remember, I was saying that you may look at production, you may look at sales, you're going to have to look at what's the cash coming in, what money is going to go out. So the various aspects of that budget, there's different pieces. There's different little budgets that go within the master budget. And then control. So it involves taking steps that increase the objectives set down by management and what we're planning to attain, and then all the parts, how they work together to toward a common goal. So here's kind of a little planning perspective. So we have defining our goals and objectives, what we're thinking about for the plan and the future ahead, means of allocating the resources, we're uncovering potential bottlenecks. Hopefully we can work through some issues before we even get into the new period, coordinate activities, and we can communicate plans. So this is going to take, not just management, but a lot of people in the organization in order to put this together. So from a control standpoint, organizations compare their budgets to actual results. So even if you're not with a manufacturing company, this is a very popular process. You want to look to see, what did we estimate and what did we budget for something, and then what was the actual result, what actually happened. So in my business that I'm in, we're budgeting for certain rents, people come in and out. We're looking to see how much per square foot we think we're going to get for the building, and then we're going to compare it and look at it, and we do it on a quarterly basis, and we compare, and we have our variance reports. So we'll look at it and we'll say, okay, so how did we do? Did we actually have a favorable or an unfavorable balance for that period of time from what we budgeted? So we want to improve the efficiency and effectiveness of the operations, and we want to evaluate, sometimes reward employees. In a manufacturing plant, there's rewards that can be tied to some of the employees that are within that organization at different levels. And then we have companies usually create the budgets by relying on some combination of top-down budgeting and self-imposed budgeting. A self-imposed budget or participative budget is a budget that is prepared with the full cooperation and participation of all managers at all levels. So this is what I've experienced at the places that I've worked, is that it's usually going to be a joint effort at managers at different levels in order to provide input into the budget. Okay, so this could be how it looks. So you have your top management, you have your middle management, and you have your supervisors. So there's usually some kind of tiered, format of the organization. So what happens is, a lot of people that are, let's say in the plant setting, you have those project managers, or you have those plant managers. You may have different departments within the plant, and so you are going to have those people that at this supervisor level that are going to be giving you input, and maybe the input's going to their manager, which is that middleman, and they're looking at it and they're giving their input, and they may tweak it a little bit, and then it goes to upper management at that point. And so usually upper management are the ones that are able to make the decisions, maybe make changes to those budgets to come up with the final numbers, because usually top management has that final say. So they'll take the input and they'll make decisions based on that. So there's some advantages to that self-imposed budget, which is what we were talking about with all those people that participate in the process. So it shows respect and opinions of that lower level manager. I mean, usually those lower level managers are the ones that are dealing with the day-to-day operations, and they have really good input. And so, when upper management looks to them for the direction or the budget numbers or different input, that shows respect for them. And then budget estimates prepared by frontline managers are often more accurate because they're the ones that are out there working, in that process. So they usually are going to have a little bit more accurate input and probably more influence and what goes into that budget. And then motivation is generally higher when individuals participate in setting their own goals and when the goals are imposed from above. So if you're in charge of, helping set a budget and you're going to be tied to a bonus or a reward, then you want to make sure that you're setting that, budget in a reasonable fashion and that you're able to meet those goals, because now you're going to be committed to making sure that whatever was put into process and planned out, you have a reward tied to it. So you're going to have a little more effort in making sure that the goals are met. It empowers them to take ownership of the budget and to be accountable for deviations from it. And so that just goes back to what we were just talking about. If you're putting that input in, you're definitely going to have ownership of it, and you're going to want to be, stick to that plan, because you're not going to, you don't want to have to go through and have to, talk about a variance. And sometimes there's things that are out of our control, and you do have to note those variances when that happens. But hopefully when you're setting the budget, you're taking into some of the considerations that are going on in the economy at the time and what's happening within the organization. And you can put that together and have, an accurate budget. So self-imposed budgets should be reviewed by higher level of management to prevent budgetary slack. And then most companies issue broad guidelines in terms of overall profits or sales. Lower level managers are directed to prepare budgets that meet those targets. So that's just everybody working together. And there's expectations from the top. There's some realistic things that go into it from lower level management that's fooling with the day-to-day operations. And so there's a compromise that's met. And then there's an agreement and a final plan that gets put into process. So we have different aspects of the budget that we're going to be looking at. And so there's a lot of things that we have to consider. So we have that sales budget. We have to know, what is our plan for sales? What are we looking at that we're going to be selling? For this example and chapter that we're going to go through, we're looking at the production of products, right? So we're planning on selling those items. And so we got to figure out, like, what is our sales for the year? What are our goals? Once we kind of establish that, then we know that we can figure other things out. So what is involved with selling that? How much do we have to produce? How much do we have to keep on hand? And so there's going to be some decisions that are made. So we'll have to set up our production budget based on the sales to make sure we are make sure that we're on track to cover all of the sales that we're expecting. We also have goals for our ending inventory. So we got to do our ending inventory budget, which goes into that production. And then we have to look at how much material, what kind of labor, what's the manufacturing overhead. So we have to put all of that together. What does that look like? How much is that going to cost us? And then we have our cash budget, because we have cash coming in, we have cash going out. And we want to make sure we have enough cash coming in that's going to be able to cover all the expenses of the production in order to be able to pay all of the expenses and costs that go along with that. So also we're going to have some of those period costs of selling and administrative budgets have to be considered, because you're going to have some of those expenses as well. Sometimes they are flexible, like when you have sales teams that are out doing different things, they may have commissions that come through at different times, depending on how the commissions are set up. So you have those expenses, you have admin stuff that's just coming through every month. That's you have your offices and all that stuff that's coming through monthly, and it's fixed, so it's not changing. So we got to cover all of that as well. And then we look at the total budgeted income statement and the budgeted balance sheet. So we're going to walk through an example that's going to walk through all of that. All right, so they're going to talk about 10 schedules in the master budget to help you get the big picture. And then there's 10 questions to help with that. So we have, how much sales revenue will we earn? How much cash will we collect from the customers? How much raw material will we need to purchase? How much manufacturing costs will we incur? How much cash will we pay our suppliers and our direct laborers? And how much cash will we pay the manufacturing overhead resources? What is the total cost that's going to be transferred from finished goods to cost of goods sold? So we got to make sure when we have a sale, we're pulling it out of that finished goods inventory. We gonna now have a cost of goods sold because we sold the product. So if you remember from earlier in the semester, we kind of walked through that process. How much selling and admin will we incur, and how much cash will be related to those expenses? How much money will we borrow and repay to the lenders, including interest? So remember, when you have these loans with the interest, you got to make sure you put that into the budget so you can make sure you're covering all of those costs as well. How much operating income will we earn? And what will our balance sheet look like at the end of the budget period? Because remember, we may want to have some inventory left over because we, always want to try to plan to have some ending inventory that going into the next month, so we have some availability there. And also, like, a lot of this is what we talked about on that other screen, kind of walking through those different budgets, and why you have to know how much sales. Why do you have to know? What do you have to purchase? Well, you have to know how much to purchase in order to be able to produce the product. So we buy in that raw material and making it into something else. The other thing that they don't mention on here to consider is when you're in a economy like we are now, we have a little bit of a supply chain issue. You have to make sure you plan in advance for those delays, because right now there's been a lot of delays in getting raw material. So maybe, that is discussed so that we know, okay, how much we need to purchase. Maybe we're purchasing a little extra this year in order to get ahead of the game. So maybe there's a long lead time. And so if we want to have an ending inventory of so much, then we have to make sure we purchase this, because we're going to have these long lead times and we need to get ahead of the game. So that's going to be a lot of different things to consider. And, the times that you're living in and when you're planning are definitely going to come into play when you're planning for those budgets. So a master budget is based on various estimates and assumptions. So right now, if we are planning to redo a parking lot, or we're planning to add more square footage to a building, we're going to have estimates on vendors that we work with. And those estimates are going to come in based on today. They'll tell us what the lead times are. They'll tell us how much it's going to cost. And then we'll take that and put it into our budget. But let's say that's a project that we're not getting to until the end of next year. And I'm getting these estimates in October of this year. So it could be 12 months or longer before I'm actually doing a job that I estimated. Well, what happens? Sometimes, with supplies, especially right now, the cost of goods have gone up. So we have to consider that sometimes we may have budgeted for something and the cost of that has gone up because now it's a longer delay. So sometimes you may want to have a little contingency in there with a little extra in the budget in order to cover for those contingencies, because sometimes costs do go up. So what are the budgeted unit sales? What are the budgeted selling price for the unit? What's the percentage of accounts receivable that will be collected in current and subsequent periods? So maybe we have to offer incentives to have a better cash flow. That's an option. So sometimes we'll give them a little discount, and that's all talked about in principles, where you have maybe a customer that's offered a discount if they pay in advance. And that helps you with your cash flow and money coming in order to be able to buy the materials you need for the next job. So that's something also that could be talked about and considered. So We have Excel that we can use for budgeting. And so this is just explaining that there's assumptions that you can make in Excel. A lot of people use Excel for a lot of different things. We currently are using Access for our budgeting system. So there's different softwares that are available. Sometimes, depending on the industry that you're in, there may be a software that's written specifically for that industry. And so they'll have modules in there in order to create budgets. But this is just one option using Excel. And, there's other options out there. All right, so we're going to look at Royal Company, and they're preparing budgets for the quarter ending June 30th. So we have budgeted sales for the next 5 months. So this is how many units that we're expecting that we're going to sell. And the selling price is $10 per unit. So they'll give you some information and you'll have to do some of the calculations for this. So we're going to look at the sales budget. So the individual months of April, May, and June are summed to obtain the total budgeted sales in units in dollars for the quarter ending June 30th. So they have Excel, and they're showing you an example of how this can be broken out. So we have our budgeted sales in units. So they're just plugging in these numbers, April, May, and June. So we have 20, 50, and 30,000. So for that quarter, we're expecting unit sales to be 100,000. They gave us the selling price, so we're going to plug that in. So now we know what our sales and units are for our budget. And then how much do we expect to collect in sales? So we just take the number and multiply it by the $10. So 20,000 times 10 gives me the 200,000 in sales. And then we do the same thing for May and June, total them up for the quarter. So we're expecting $1 million in sales for the quarter. How much do we expect to collect? So they have a pattern at their organization. Usually 70% are collected in the month that they sell the product, and then 30% carries over to the next month. So in April, the March 31st accounts receivable of 30,000 will be collected in full. So you need to know that because you need to know what rolled into April. So they're going to have to give you the information from the previous month sometimes, or the month after, in order to be able to make some calculations. So they're telling us April has 30,000. So that's going to roll in, and I'm expecting that I'm going to collect that in April, but it's from my March sales. Okay. So then I'm collecting 70% in the month. So what am I expecting for April? In April, I'm expecting 200,000. So I can calculate that out by timesing it by 0.7 for the 70%. So I take 200,000 times 0.7. So I'm expecting 70% in the month that it happens. So in April, I'm going to plug in the 70%, which is 140,000. And then the remainder, the 60,000, I'm going to collect in May. And then we need to do the same thing for May. So May, we go back to the sales and look to see what it is. So we had 500,000 in sales. We're going to multiply it by 70% and expect to collect that in the same month. So that's 350,000 in May. The remainder is going to be collected in June. All right. So it says, what will the total cash for the quarter be? So we've already calculated out April because we knew it was coming in. We had April sales. We calculated May because we knew it was coming in from April, and we had the May sales. Now for June, I know what's coming in from May, but I got to calculate out what am I collecting in June to add to this total in order to get the right answer. So I got to go back to the information that was given to us. So in June, we had 30,000 units at $10 each, so 300,000. And I'm expecting to collect 70% of that in June. So I have to add 210,000 to my total for June. So we can add all of that up. So let's add it up and see what we get. So we have 30,000, 140,000, 60,000, 350, 150, and then we just calculated 210, I believe. Okay, so the total, when we add all of that up, including the 70% from the June sales, we get 940,000. So the answer should be D, 940,000. And then here's the schedule. So it's showing you June sales times 70%, we get 210,000, and then you just add this column up, we get 940,000. Okay. So for June, we have 30% going into July. So that's mean 90,000 will roll into July. Okay, so now we're going to look at the production budget. So we did the sales budget and the expected cash collections. That's the two that we've done so far. So now we're moving on to budget for the production. Did y'all have any questions so far? Are y'all okay? Okay, we're good. All right, so the management at Royal Company wants ending inventory to be equal to 20% of the following month's budgeted sales in units. On March 31st, 4,000 units were on hand. And so now we're going to prepare the production budget. Okay, so we're bringing in our budgeted sales. We have our units here, 20,000, 50,000, 30,000, 100,000 for the quarter. So that's just information that was given to us. Okay, so then we're going to add the desired ending inventory. So remember, they tell us here that it's 20% of the following month's budget. So we need to do the calculation for that. So what is my desired ending inventory for April? So April, I have to look for the following month's sales, which is May, 50,000 units. And the desired inventory is 20%. So my desired ending inventory is 10,000 units. So if I'm planning to sell 20,000 units and I want an extra 10,000 going into May, my total need is 30,000 units. Well, they gave us some information. They told us that we had at March 31st, 4,000 units on hand. So I don't need to produce the entire 30,000 because I already have some that rolled into the month from the previous month, 4,000. So my required production is 26,000 units. Okay, so then we're just going to do that for May and for June as well. So the question says, what are the required production for May? But we have to do all the calculations for this. So on May, we have 50,000 in units that we're budgeting to sell. Then it says, what's my desired ending inventory? So I got to look to the next month, 30,000, times it by the 20%. So I have 6,000. So I have 50 plus 6,000 to give me my 56,000. But what comes into my beginning inventory? I have 10 coming forward. So this 10 that was my ending inventory is now going to be my May beginning inventory. So I need to sell 50. I want to sell 50,000. I want to have 6,000 left over to go into the next month. So 56,000 is what my need is, but I have 10,000 already. So I'm going to deduct it. And so my required production for May is 46,000. So they want you to go through that process to figure out how do we calculate this out. So what is the required production for May? It should be the 46,000. And that's how it was calculated. So I'm going to show you here on the screen. So remember, the ending inventory becomes the beginning inventory. So that's 6,000 that's sitting right here in May is going to become the beginning inventory for June. So that would just get moved right here. Okay, then in order to calculate June, I have to know what the sales are for July in order to get 20%, for June. So I need to know before and after stuff going on in order to be able to put the budget together correctly. All right, so we're going to look at the completed one. And it says that July sales, they're expecting 25,000 units. So we'll take 20% of that, which is my 5,000. Okay, so now I have my ending inventory plus what I'm expected to sell. So I need 35,000 units. but I have 6,000 that came in from May. And so now I have a total of 29,000 for June. And then we can add them together. And so now I see how much do I need to produce for the quarter, and it's 101,000 units. Okay, so that's the production budget. So now we need to look at direct materials budget, the schedule of the expected cash disbursements for those purchases of the materials, right? So I need to buy the materials that I need to use for this production process. All right, so at Royal Company, 5 pounds of material are required per unit of production. Management wants material on hand at the end of each month equal to 10% of the following month's production. And on March 31, 13,000 pounds of material are on hand. Material cost is 40 cents per pound. So we're going to look at the direct materials budget. All right, so all we're doing is taking the production budget, where we ended here, the required production 2646.29. That's kind of what we're starting with here. So we have our production. This is what we know we have to produce. Okay, so we need to figure out how many pounds we need, and then how much is that going to cost us. So we got to do the calculation for that. Well, what was given to us is back here saying that they have 5 pounds of material required for each unit of product. So I'm going to take the 26,000 times 5. I have production needs of 130,000 pounds. So I need to figure out what my desired ending inventory is, and we need to look to the information that's given up here that says management wants materials on hand at the end of each month equal to 10% of the following month's production. So if you know the following month's production, then you can multiply it by the 10%. So May, we need 46,000 units times 5. That's 230,000 pounds times 10. So now this is my ending inventory, 23,000. So we're basically doing the same thing that we did on that last one. Oops, sorry. That we did on that last slide. But we're looking at the pounds that we're needing to produce those units of whatever that raw material is that we're buying. Okay, so we do the same thing. We have production 26,000. We need 5 pounds each. We need 130,000 pounds. We want an ending inventory of 23,000 pounds. So how much do I need? I need the 130 plus the 23. So I have 153,000 total. And then I need to deduct what was brought in from the ending from the inventory that came in from the March 31. And it's 13,000. That was the ending inventory in March. So I can deduct that. So I need to purchase 140,000 pounds in order to produce the 26,000 units of production. Okay. So I need 140,000 pounds of my raw material in order to produce 26,000 units. All right. So now we have to calculate and fill in the rest of the quarter. They want to know how much materials should be purchased in May. That's our next question. So we need to look over here. So we know it's 230,000, but we got to figure out what's that desired ending inventory. So remember, we got to look to the next month to see how many pounds do we need? 145,000. Multiply it by the 10%. So that's 14,500. I have to add that to the 230,000. So I have 244,500. And then I need to look to see what was my desired ending inventory, 23. Well, that becomes my beginning inventory. So I need 244,500. However, I can deduct what I already had. So I have 23,000 pounds. So materials that I need to purchase are 221,500. Okay. And it shows you the breakdown right here of what we just talked about. So the 14.5 is just right here, 445,000 times 10%, bringing my 23 down. So I'm just adding my 230 plus my 14.5, deducting my 23,000, and I have 221.5. Let's see what it looks like for the end of the quarter. Okay, so the beginning inventory from April is the 13,000. So So what's happening is they have to calculate out this based on that production that's happening in the next month, which is August. And I can't remember if they gave us that information. Maybe they would have to give it to you in order for you to do the calculation. But they may have given it to us way back on the slide when they told us about the production on that like first slide, which is way back there. All right, so remember the 11.5 is going to be some calculation that came from what was the pounds that we had that we needed for July multiplied by 10%. That's where that came from. 14.5 is moving over here to the beginning, so I can deduct it. So it's 142,000. Okay, and then this is my quarter totals. All right, so Royal pays 40 cents per pound of its material. So now we know how many pounds we need. Now we need to calculate how much is it going to cost me. So 40 cents per pound for the material. We know that half of the month's purchases, we're going to pay for it in the month that we purchase it. The other half we're going to pay in the next month. And then we have on March 31st, the accounts payable balance is 12,000. So that's what's going to come forward into April that I'm going to have to pay out. So now I'm going to calculate how much cash am I going to be spending. So I have accounts payable at 12,000. I know I'm going to have to pay that out. They just gave me that information. Now I got to do some calculating. So I got to look back to my production in pounds. So I have 140,000 pounds right here in April. That's how much I need to purchase. And so I need to do a calculation. It's 40 cents per pound. So that gives me $56,000 that it's going to cost in total for the whole 146,000 pounds. But remember, the information that was given to us was that we were only going to pay half of it in the month that we purchase it and the other half in the next month. So we're going to split the 56,000 into 2 months. So you have 28,000 in April and 28,000 in May. So what are the total cash disbursements for the quarter? So it wants us to go through and calculate all of that. So I am going to bring us down here to the end so I can show you on the screen because it's easier than trying to write all that out and going back and forth. All right, so we would have to look at the May pounds and calculate that by the 40 cents. So remember, May was 221,500. That's how many pounds that we needed to purchase, and it's 40 cents per pound. So that is where the 88,600 is coming from. Okay, so that's how much that total costs to buy that many pounds is 88,600. So 221.5 times the 40 cents. The 40 cents was given to us. That's how much they told us it was going to cost. And then the 221 is what we calculated for the direct material budget. All right, so we split that in two. So we have 44,300 going in May, 44,300 going into June. And then we have to look at the June production. So that was 142,000. So we take the 142,000, multiply that by 40 cents, and we get 56,800. And half of that is paid for in June, so 28,400. And then we add it all together. I need 185,000 in order to pay for all of the raw material that I have to purchase. Okay. So, all right, we're going to look at the direct labor budget now. So at Royal, each unit of product, well, do y'all have, before I go into labor, do y'all have any questions on the direct material and how we calculated the pounds that we needed and how much it was going to cost and how much cash was going out? Do y'all have any questions on that? Okay. So direct labor. At Royal, each unit of product requires 0.05 hours, so 3 minutes of direct labor. The labor can be unskilled because the production process is relatively simple and formal training is not required. Royal pays its workers at a rate of $10 per hour. All right, so we're starting back with our units of production that came from the production budget that we had done earlier. So we need to produce 26,000 units. And the information that was given to us is that it's going to take 0.05 per unit of product. So all we're going to do is take 26,000 times the 0.05, and we come up with 1,300 hours that are needed. We do that for each month. Okay. Then we know our hourly wage rate because it was given to us. They said it was $10. So now we're going to calculate out, this is how many hours that I need, and this is how much it's going to cost per hour. So we just multiply that to come up with the cost for the direct labor. So we calculate 1,300 times 10, that's the 13,000, and do the same for May and June. Okay, so that was the labor. And now we're going to look at the manufacturing overhead. So remember, we always have those three pieces. This is what we started with from the very beginning. We had direct material, we had the direct labor, and we had the manufacturing overhead. So now we're going to look at manufacturing overhead and how do we budget that? All right, so at Royal, manufacturing overhead is applied to units of product on the basis of direct labor hours. The variable manufacturing overhead rate is $20 of direct labor hours. Fixed manufacturing costs are $50,000 per month, $20,000 are non-cash, which means that's something that's happening that's causing an expenditure, but you're not spending any cash. So let's look to see what that looks like. So we're starting with our direct labor hours that we just calculated. So remember, we had 1,300 at the end of April that we calculated out that we were going to need. They're telling us the manufacturing overhead rate for variable is $20. That information was given to us. So we take the 1,300 times $20 to come up with my cost of $26,000 for variable manufacturing overhead. Then it gave me my fixed cost of $50,000. And that gives me a total cost for April of $76,000. And I do the same thing for May, same thing for June. And then I calculate it for the quarter. And we're going to calculate our rate based on the whole quarter. So we're going to look to see, remember when we calculated out that predetermined overhead rate, we had to know that cost over the whole quantity. So we're going to do our total manufacturing for the quarter, which is $251,000. And then we had the total labor that was required. So that's my quarterly total, 50/50. So I take the 251 divided by the 50/50, and I get 49.7 per hour. All right, so now I'll extend this out a little bit further. I'm going to take out my non-cash costs. So I'm not spending any cash here. This is just an expenditure that we've done an entry for on the books. So I'm going to deduct that out. So my cash disbursement is $56,000 for April when I take that out. And then we do the same thing for May and June. So I'm not spending the entire 251 because some of that is a non-cash transaction. So I'm going to pull that out. So I just deduct it. 251 minus the 60,000, it's 191,000. That's my cash that I know that I'm going to have to spend out for the quarter. Okay. So now we're going to look at finished goods inventory budget. All right, so we have direct materials was 5 pounds at 40 cents. So we get $2. And let me see, I know that they told us it was the 40 cents. I remember that. I'm trying to go back to the $5. Where did that come from? See if we can find it. I think it's the 5 pounds right here in the beginning. So it's 5 pounds per material. That's where it's coming from. So at Royal Company, 5 pounds of material are required per unit of production. So we're going to take the 5 pounds, multiply it by the 40 cents to come up with the $2. Let's see, I got to go a little further. Here we go. Okay. And then we're going to look at our direct labor, and they gave us the information that the direct labor was 0.05 per hour, and it was $10. That was the rate. So we multiply that. So we have 50 cents. And then we look at manufacturing overhead, which we just calculated, that overhead rate, that $49.70 times, and it's by direct labor hours. So it's going to be the 0.05 hours per unit. So I'll come up with $4.99 per unit. Oops. So ending inventory in units, the unit product cost is going to be $4.99. Down here, they're telling you again where that $49.70 came from. That was that calculation that we just did for manufacturing overhead. All right, so the budgeted finished goods inventory, we had ending inventory in units of 5,000. The unit product cost is $4.99. And then the ending finished goods inventory, when you multiply it, it's 24,950. So we know what's going to be left in ending inventory based on that cost we just calculated per unit and the amount of units that we were going to have in ending inventory at the end of June, which came from the production budget. Any questions so far on all that labor and manufacturing overhead? Okay, so now we have selling and administrative expenses. So at Royal, the selling and administrative expense budget is divided into variable and fixed components. Variable selling and expenses are 50 cents per unit sold. Fixed selling and administrative is 70,000 per month. So it tells us 10,000 of that cost is primarily depreciation, and that there are no cash outflows for that month, that $10,000. Okay. All right. So we have our budgeted sales, 20,000 units. Variable selling and administrative rate is 50 cents per unit. That was the information that was given to us. So we calculate it out by multiplying. So we get 20,000 times 50 cents to $10,000. Then we have our fixed expenses of 70,000 to come up with a total expense of 80,000. Then we want to pull out the cash transaction of 10,000. So we're deducting it, 80,000 minus the 10,000. My cash expense is going to be 70,000 for my selling and administrative. So what are the total cash disbursements for selling and administrative expense for the quarter? All right, so we're going to go back and look at this table. All right, so here's my budgeted sales. 50 cents is my rate. We just multiply that out to get the first number, the total expense. We have our fixed expenses of 70,000 each month. And then we have our 10,000 being deducted each month. So we have a total of 230,000 when we add all 3 quarters together. So that's my selling and administrative budget. All right, now that we've calculated everything out, we can look at the cash. We've calculated out how much we're expecting to collect. We've calculated out how much we were going to need to spend on that material, on the direct labor, how much we were going to have to spend for manufacturing overhead, and our selling and administrative. So now we can do the cash budget. So we have cash receipts. It's listing all the cash inflows. The cash disbursement is the payments that are going out. It's telling you here, exclude repayments of principal and interest. And then it says cash excess or deficiency section determines if the company will need to borrow money. So once we look at this, we can say, okay, we have enough money to cover everything and extra, or we may be short and we have to, we'll have to finance the money. And then we may have a financing section that details the borrowings and the repayment projected to take place during that period. All right, so we have to assume some information. So we're assuming they maintain a 16% open line of credit for $75,000. They maintain a minimum cash balance of $30,000. So we want to make sure that we cover in that by leaving that cash in the bank. And then we want to borrow on the first day of the month, repay loans on the last day of the month, pay a cash dividend of $49,000 in April, purchase $143,700 of equipment in May, and $48,300 in June. They both being paid with cash. And April 1, the cash balance is $40,000. So we're going to start with that $40,000 because we know that's my beginning balance. So we want to add the collection. So now you have to go through all of those budgets that we just did and find the total monies that was being collected, the total monies that was being spent out on each section. So if we went back to that earlier slide, it would show the $170,000 was my collections for April. So my total cash is $210,000. And now I'm going to walk through all of the expenditures. So this is what's going to be spent during that month of April. So we have our disbursements of $40,000 for materials, $13,000 for direct labor, $56,000 from manufacturing overhead, selling and administrative expense, $70,000. That was the amount that they had given us. Then we have equipment purchase, which I don't think happens yet. It doesn't happen till May. So that should be zero. And then we have a dividend we're paying out of $49,000. We add our total disbursements, $228,000. So what happens? Our cash collections are only $210,000, but the disbursements of $228,000. So we spent a little more than what we have cash coming in. So we have a deficiency of $18,000. So what do we need to do? Not only do we need to cover that, but we also have to cover that, cash that we want, right? So we have to cover that $30,000 plus the $18,000. So if we add them together, we need to borrow $48,000. And remember, we have that line of credit that we can borrow from. So we have $48,000 that we're borrowing, and our ending cash is $30,000. And that's what we wanted for our ending cash. So it's going to say, what is the excess or deficiency of cash available over disbursements for June? So they're giving us May. And then you would have to go back to all the slides and grab the information to key this in to calculate June. But I'm going to go ahead and show you the slide here that has all the information on it. All right, so we started with $40,000 in June. So if you notice on the schedule, what's happening is whatever the ending balance is down here at the end of the month, that number is just brought up here as the beginning balance for the next month. Okay, so that's probably a formula in Excel that's just reading that cell down here. And then, so for June, we had $40,000 in the beginning balance. We had collections of $360,000. So now we have available cash of $400,000. And then we walk through putting in, they covering it so I can't see it. Let me see if I can move this for a second. Down here. Okay. So we had materials, direct labor, manufacturing overhead, our selling and administrative $75,000. We had equipment purchase that month of $48,300, and that was just the month that information was given to us. We had, remember, the $143,700 in May and the $48,300 in June. So we add all of our disbursements up and we deduct it from the cash to see what do we have? Do we have an excess or a deficiency? We have excess of $130,500. So now I have enough that I can pay that that money back. Let's see if I can get this out the way now. I can't move it. There it goes. All right. So now we're going to pay back the $48,000, but we have to calculate interest. And they're showing you how to do the calculation here. So we had $48,000 that we borrowed. They gave us the information of 16% was the rate. So we have 16%, that's an annual rate. So we have to divide it by 12 months. And then how many months did we have it? We had it April, May, and June. So that's 3 months. So we're going to times it by 3. So my interest is $1,920. Okay, so I need to deduct that from my cash as well. So the total financing is going to be the 48 and the 1920, the $49,920. So I deduct that from the excess cash of 130,000. And so now my cash left over is 80,580. And that's what I have going into July. All right. So now we need to do the budgeted income statement. So we're going to look to see our sales and our costs and all of that. So we're expecting to sell 100,000 units at $10. So we expecting that 1 million in sales. They're telling you over here what budget it comes from, so you know where to go back and look for the information. If you're going back through this reviewing and you want to know where the numbers came from, you can go back to those budgets to find it. Then we have a cost of goods sold. So it was 100,000 at $4.99. We calculated out that per unit. So it's 499,000. Then we have gross margin of 501,000. So remember, we take the sales minus the cost of goods sold to get our gross margin. And then we need to deduct our selling and administrative expenses. That comes off the selling and admin expense budget. That was 260,000. So our operating income is 241,000. And then we had interest expense of $1,920. So my net income is $239,080. All right, so now we're going to look at the balance sheet. So they're going to give us a little bit more information because we didn't know everything that they had for the balance sheet. So they're going to give us some more information here. So they're telling us they have land of 50,000, common stock of 150,000, retained earnings of 248,650 as of April 1, and equipment of 175,000. Okay, so remember the balance sheet has our assets, our liabilities, and our owner's equity. And the total assets should equal what? Liabilities plus equity. That's that accounting formula. So this total asset number should equal the total liabilities plus equity number. All right, so we have cash, 80,580. You can get that probably off that cash budget that we did. That's the ending balance. We have accounts receivable of 90,000. So if you want to remember what they told us about accounts receivable, that when we have when we collect the money in the month of the sale, we don't collect 30% of it. We collect that the next month. So that's going to be open as an open receivable at the end of June because that money is still due. So it's, remember, accounts receivable means I have an account that I'm expected to receive money. And then we have raw materials inventory of 4,600. So that is coming from that raw material budget that we had done. It's saying that we needed 11,500 pounds is what we had in that raw material inventory at the end. And we can multiply it by 40 cents because that's how much they told us it was per pound. And we get 4,600. Then we have finished goods, 24,950. There's that schedule that we did that showed the finished goods inventory. It was 5,000 units times the 499 per product. And then we had the land that was just given to us. And we had equipment that was also just given to us with the 2 new purchases that we did during the quarter. So on the side here, it tells us our equipment was 175. But remember, when we went through a minute ago, they gave us some information for our cash outlay that we were also purchasing 143,007 and 48,300. So if you add those two together, oops, too many zeros. So those two numbers is 192,000. And then let's see. Okay. We had 175,000 already before we went into that quarter. So it's 367,000 total. That's where that comes from. Okay, gotta remember to add in the 2 from the current quarter. So we have total assets of $617,130. Now we have accounts payable, 28.4, and that comes from, remember we were doing the calculation for how much we were going to need to spend to buy the material, and we said that 50% was going to be paid in the next month. So we know that that is open because we haven't paid it yet. So I have an account that shows I have to pay someone in the future, and that's 50% of June purchases. So I have 28,400 as an open accounts payable. Common stock of 150, which was just given to us, and then we had retained earnings of 248,650. That was given to us on this slide right here as of April 1. But remember, we had some net income for third quarter that we just calculated. So that net income is going to roll into your retained earnings. So we have 487,730. So when you add them together, you get 438,730. So when we add everything, 617,130. So my assets equal my liabilities in equity. So that was walking through the master budget. And on this last slide, what I had just done about with the retained earnings, this is the little formula here. If you don't remember, we talked about this in the beginning of the semester. So we have our beginning retained earnings plus that income, less our dividends, and we'll get our ending balance of that 438,730. So they told us on the, let's see where it is, the slide that they were going to pay out the dividend. I think it was, let me see where it's at. I know I remember reading it, that on one of the slides right here. So the total that that you come up with your retained earnings and your net operating income was that 487,000. You got to remember to deduct the cash dividend. And then you get the 438,730. So that's the calculation that's done on this last slide here, down here at the bottom. So beginning retained earnings plus that income less dividends is going to give me my ending retained earnings. So that is it for the budgets. It's a lot of little calculations. It's not terribly hard on some sections. You just got to make sure you follow the directions on how to calculate it out. And then, you know, you want to make sure that you are looking at, you know, the information with the products. Make sure that when you're looking at the units, you understand that you have to calculate out how much raw material you need to produce those units, and then calculate the cost on that number. Don't just times the number by the number of units when you're doing the production budget. And there'll be some homeworks that walk through this so you're comfortable with it. Now, obviously, we can't do a big old example like this on the test, but I will give you example problems on the study guide that will help with knowing what you need to know. You might need to know how to do a piece of it. I may give you the cash budget and say, okay, this is, you know, what we're expecting that you're going to have to pay out, or this is what we're expecting we're going to collect on that receivable. And how much did you have to collect? How much would you collect for the quarter? Or how much would you spend on this for the quarter? So it'll just be a piece of it. It won't be having to put a whole budget together on the test. Any questions on chapter 8? Okay, so we're going to move on to chapter 10. So we have standard cost and variances. So we're going to be looking at Standard cost is basically like an estimated cost and estimated hours that that we come up with. And then we're going to be comparing that to what did we actually pay out? What was the actual quantities in order to calculate out what was estimated versus what was our actual and come up with a variance. And was it favorable or was it unfavorable? So we're going to walk through some different examples with this as well. But we're going to talk a little bit about it first so you can get a better understanding of what it is that we're doing. Okay, so we have standards, which are benchmarks or the norm for measuring performance. In managerial accounting, 2 types of standards are commonly used. So we have our price standards and we have our quantity standards. So the price standard is to specify how much would be paid for each unit of input. Okay, so that's what we're expecting that we would pay. And then the quantity standards is how much we're looking to have for each unit of product and possibly each unit of service. So we want to know, what are we expecting that quantity to be per unit? And then we're going to compare it to what actually happens. So some examples of organizations that are doing this concept is Firestone, Sears, McDonald's. We have hospital, construction, manufacturing companies. So when I worked for the audiovisual company, we did something kind of similar to this. We would look at the prices that were standard for the different types of products that we'll be using on a job. We would also look to see what was the standard on how long did it take to install certain products. And so we would come up with estimates for quantity, for labor hours, for pricing on the products. And we would have that in our system as our estimate. And then we would go through to the project and move. Let's say we finalize the project, and then I can look and compare. There's a report that would compare the two. And so you can look to see how many hours you spent and how much money was it on labor versus what was the estimate. What happened with the products, and did we have to buy more units, or was it the price that was high? And so we would look at the analysis and try to make some decisions moving forward, because you can help. It helps you figure out where maybe you need to have a little more efficient budgeting, more efficient estimates on what you're going to be using to cost out your jobs and your products. All right, so for direct materials, we have a standard price per unit. So the final delivered cost of materials net of discounts. And then standard quantity of per unit is just the bill of materials. That's how much quantity was used in the bill of materials. And then we have our standard rate per hour, which is often a single rate that's used to reflect the mix of wages that are earned. And then we have our standard hours per unit. That's how much time in motion studies for each labor operation. Okay, so we have our material and we have our labor. And then we also have our number 3, manufacturing overhead. So we have a price standard. We have the rate is the variable portion of the predetermined overhead rate. And then we have the quantity standard, which is the quantity is the activity and the allocation base for the predetermined overhead rate. So remember, when we were calculating out the predetermined overhead rate, we're estimating, how many labor hours or machine hours were going to be used on a production line, and then how much do we think that was going to be as far as price. So that's all of our standards, and this is an example of a standard card, what it would look like. So we have some inputs. We have direct materials, direct labor, manufacturing overhead, and so we have A and we have B, and then we multiply A and B together. So A is our standard quantity or the standard hours if we're looking at labor. So we have 3 pounds of material, and then we look at the standard price or the rate. It's $4 per pound, and I can calculate that out by multiplying it together to come up with my cost per unit. For my labor, I'm doing the same thing. I'm looking at my hours times the rate, coming up with the total rate per unit. And I do the same thing for manufacturing overhead. And then I get my total cost for a product. That would be my standard cost. Okay, so that's just those estimated prices and rates, or those estimated hours or quantities. So we have standard costs per unit for direct materials, direct labor, and variable manufacturing overhead. It can be used to compute activity and spending variances. So our spending variance becomes more useful by breaking them down into price and quantity, because sometimes we look and say, okay, the price was higher, but was it because we had more quantity, or was it the price that was off and the quantity was correct? So we want to look at both of them. And then we look at the variance analysis. So we have a price variance that shows the difference between that actual price and standard price, which is that estimate. And then we have the quantity variance, which is the actual quantity that was used versus what we had in the standard quantity, which was our estimate quantity. So we have price and quantity standards determined for two reasons. The purchasing manager is responsible for the raw material purchase prices, and the production manager is responsible for the quantity of the raw material. So we have the purchasing manager for the pricing, and we have the production manager for the quantity. So the buy-in using activities occur at different times. The raw material purchased may be held in inventory for a period of time before it's used in production. All right. So now we have our price variance, which is the material price variance, the labor rate variance, and the variable overhead rate variance. So those are the three variances. And for quantity variance, we have the material quantity variance, the labor efficiency variance, and the variable overhead efficiency variance. So that just means we're looking to see here, the efficiency is just those hours that were used, or those standard rates that were used, and how did that compare to what actually happened? How many hours did we use? How many hours, and how much did that cost for those hours per unit? All right, so this is going to make more sense when we walk in through an example, but this is kind of how we're going to be looking at the analysis. So we have actual quantity of input at the actual price, and then we have the actual quantity of input at the standard price. So that's how we're going to tell what was the price variance. We have to keep the quantity the same. So we have the actual quantity for both. And then we calculate the actual price and standard price. So we have the price variance. And then for the quantity variance, we're going to be looking at the standard price for both of these. So the price is not going to change, only the quantity is going to change. So that way I can see what my quantity variance is. The two together, the price variance and the quantity variance, are my spending variance. So we have the actual quantities, the amount of direct materials, direct labor, and variable manufacturing overhead actually used. And then we have our standard quantity over here, which is our standard quantity allowed for the actual output of the period. And then we have our actual price, and the actual price is the amount that we actually paid for the input. All right, so let's see, the standard price. So remember, the standard is like the estimate. So our standard price is the amount that should have been paid for the input used. That's not the actual. So remember, standard is like the estimate and actual is the actual. All right, so let's look at the example. So we have Glacier Peak Outfitters, and they have the following direct materials standard for the fiber fill in its mountain Parker. So the Parker must be like a little jacket. So we have 0.1 kilograms of fiber fill per Parker at $5 per kilogram. And it says last month, 210 kilograms of fiber fill were purchased and used to make 2,000 Parkers. The material cost a total of $1,029. All right, so let's compare and see what our variances are. What was our actual quantity? It was 210. So remember when we were trying to find the price variance, we're going to have the same thing, the actual quantity. So we have 210 on both. What was the actual price? It was $4.90 per kilogram. So you're going to have to calculate that out. They tell you how much was purchased and used for 2000. So it tells us it was 1029 that was spent as a total cost, and it tells us that we purchased 210 kilograms. So 210 kilograms were purchased. This is how much it costs. So we'll take the 1029 divided by the 210 and come up with my price, which is $4.90. So that's my actual price. Well, what was I estimating? On here, it tells me I'm estimating 5 per kilogram. So that's my standard. All right. So the difference is 10 cents lower. And my actual is lower, which means I'm going to have a favorable balance on that one because I paid a little bit less. So when I take that 10 cents and multiply it by the 210, I get a $21 favorable variance. Then I want to look at my quantities, right? So my standard price is going to stay the same. I'm going to use the standard price and keep that the same, and I'm going to compare my quantities. So what did I have for actual quantity? 210, and I had my standard quantity of 200. So it's telling me on here that I'm making 2,000 Parkers. And what did they estimate it to be per Parker? They were saying the standard was going to be 0.1 per Parker. So that's where the 200 comes from. Okay. So that's just, I had 2,000 Parkers. My estimate was 0.1 per Parker. So that's where the 200 is coming from. You multiply those together. All right. So my actual quantity was a little higher than the standard, which means it's going to be unfavorable, right? Because I had more quantity than what I had estimated it to be. So I do the calculation, multiplying it by the $5 standard rate, then I had 1050 versus 1,000. So what happened? My quantity variance is going to be $50 unfavorable. So overall, when I look at it, I'm a little bit unfavorable, right? Because I had $21 that was favorable and I had $50 that was unfavorable. So when I'm comparing, when I'm looking at that and comparing it, they're just giving you the calculations here. I can get my total spending variance if I just add look at these two and add them together or take the difference. So if it's unfavorable $50, I'm not completely out the $50 because I had a favorable balance of the 21. So my total spending variance is 29. All right. So this is a little bit different way to look at it than what we just did. So this is just, giving you a layout of how you can do the calculations. So for the material, I have my actual quantity times the actual price, my actual quantity times the standard price. So what do I have? This didn't change, right? Actual quantity. It's just the actual quantity times the difference in the prices. So 210 times the 10 cents, and that gave me a $21 favorable balance. We can do the same thing for the materials quantity. Actual quantity times standard price minus the standard quantity times the standard price. Well, standard price is the same. So I'm using the standard price and I want the difference between the actual quantity and the standard quantity. So I'm taking the $5 and then I'm multiplying that by that 10 kilograms to come up with the $50. And that's unfavorable because the actual was a little higher. So it's just a little bit different way to look at it and make the calculation. So whichever way is easier for you, that's how I would figure out the calculations. All right, so who is responsible for the materials price variance? So remember, we talked about the purchasing manager is responsible for that. And who's responsible for the materials quantity variance? That would be the production manager. So the standard price is used to compute the quantity variance so that the production manager is not held responsible for the purchasing manager's performance. So you don't want to look at the price variance there because they're not responsible for that. All right, so the materials variants are not always entirely controllable by one person or department. The production manager may schedule production in such a way that it requires express delivery of raw material, resulting in an unfavorable materials price variance. So remember, the material price variance goes with the purchasing manager, but if the production manager is saying that he's expressing it in, well, then that's going to cause the cost to go up. So it might not be the purchasing manager's issue. And then you have the purchasing manager that may lower quality raw materials, resulting in unfavorable material quantity variance for the production manager. So the purchasing manager is going to maybe have a price that's a little bit lower, but they have to use more material for the production manager. So then the production manager is stuck with more material because it was low quality. And so so you may have some different things that overlap like that can cause problems. All right, so we have Hansen Inc. They have the following direct material standard to manufacture one zippy. So it takes 1.5 pounds per zippy at $4 per pound. Last week, 1,700 pounds of material were purchased and used to make 1,000 zippies. The materials cost a total of $66.30. All right, so how many pounds of material should Hansen have used to make 1,000 zippies? So we're making 1,000 zippies, and it wants to know what is how many pounds of material. Well, according to our estimate, it's telling us 1.5 pounds per zippy. So we'll take 1,000, if that's what we made, and we'll times it by the 1.5. So that's going to be 1,500 B. Okay. And it says, what is the material quantity variance for the week? So what was our standard price? So let me go back up. Let's see. Okay. So the standard price was the $4 per pound, and we have to look to see what we were estimating. So we had, let's see, it tells us 1,700 pounds of material were purchased, and what was the estimate? It was 1,500, right? So if we had the 1,500 and we were expecting the actual was 1,700, we had a standard of 1,500, the difference is 200 times the 4, we get an $800 unfavorable balance. So our standard price and then the difference between the quantities. So we had the 1,700 pounds less the 1,500, which was given to us as what we were estimating. So right here it's saying the 1,000 times the 1.5, that's where the 1,500 came from, and it's telling us 17 pounds of material were purchased. Okay, so we have to look at those quantity differences and then multiply it by the standard price. All right, so 800 unfavorable. And then it says Hansen's material price variance for the week was. So we have to look to see what was our actual price and our standard price. So we had a total of $66.30 is what they told us. They told us they purchased 1,700 and the total price was $66.30. Well, in order to calculate out what that is per unit, you have to divide. So we take the total $66.30 that they gave us right here, $66.30, and then we're going to divide that by what we purchased, 1,700. That's going to give me $3.90. Well, $3.90 is my actual. $4 is what I was having as my standard price. So there's a difference there of 10 cents. And let me go back down here. How much did we actually buy? We had an actual quantity of 1,700. We have that difference of the 10 cents. So we're going to take the 10 cents and multiply it by the 1,700 to get $170. And is that favorable or unfavorable? Well, if the actual is lower than what the standard price was, then we know that it's favorable. So we have $170 favorable variance. All right, so this is the chart that we had looked at earlier. They're just going to plug it all in. So the actual quantities are here, 1,700. The standard quantity was here. That's the amount that we calculated out, the 1.5 times the 1,000 units that were produced. And then we had the price. So remember, we calculated that out with the 6630 divided by the 1,700. So that's the $3.90. $4 is the standard. So we look at to see what is our price variance here for $170 favorable. And then what was the price difference between the actual quantity and the standard quantity. So we have a quantity variance of 800 and it's unfavorable. Okay, so now we're going to look at our labor variance. So you have Glacier Peak Outfitters has the following direct labor standard for its Mountain Parker. 1.2 standard hours per Parker at $10 per hour. Last month, employees actually worked 2,500 hours at a total labor cost of $26,250 to make 2,000 Parkers. All right, so what was my actual hours? They told me the actual hours was 2,500. What was the actual rate? We had a rate of $10.50. Well, where did that come from? So we're going to have to look to see what was the total labor cost. It was $26,250. And we're going to have to divide that. Let's see, let's see, employees work 2,500 hours. So we divide it by the 2,500 hours that they actually worked to come up with the $10.50. And the $10 was given to us as the standard per hour. So we do the calculations by multiplying, take the difference, and the actual is higher than what we had as a standard rate per hour. So that's going to be unfavorable. $1,250 unfavorable. That's the difference between the two. Okay, and then we're going to look at our hours. So we're using our standard rate of $10 for both. And we're going to take our actual hours, which was given to us at 2,500. And the standard hours is 2,400. So we made 2,000 Parkers. So we're going to have to take 2,000 Parkers and multiply it by our 1.2 standard hours. So here's the 2,000 that we made. Multiply it by the 1.2. That's where the 2,400 comes from. Okay, so we do the calculation. Our standard is a little bit lower than the actual. So we're going to have another unfavorable balance. So the efficiency variance is 1,000 unfavorable. All right, and then I'm giving you the calculations that we just talked about. You can lay it out this way instead and come up with the same numbers. Okay, do you have any questions so far on the calculation of the labor variance or the material variance? Okay. So we'll keep going. All right. So responsibility for labor variances. So the production managers are usually held accountable for labor variances because they can influence key factors. All right, remember the production manager is the one that's out there on the production floor, and they have control over the labor, which is the employees that are working. So they have a mix of skill levels assigned to work tasks. So sometimes you can keep the cost down a little bit if you can have a mix. And then we have a level of employee motivation. We have quality of production supervision. We have quality of training provided to the employees. So if your employees are trained properly, they'll be able to do the job more efficiently. If you have good quality of the production supervision, then the employees are going to be more efficient at their job. And then if you have good incentives in place that can motivate your employees, they're not going to be just laxy-daisy and not doing what they're supposed to do. They're going to be motivated. They're going to want to get the job done. They're going to want to do a good job from the beginning. So there's some different things that go into those labor variances. All right, the labor variances are not always entirely controllable by one person or department. So the maintenance department manager may do a poor job of maintaining production equipment. This may increase the processing time required per unit, thereby causing an unfavorable labor efficiency variance. So it could take longer if you have your products, your equipment that you're using is breaking down and causing issues. And so the labor team has to work a little longer on the production of that product. So that may not be wise, but it happens. My husband works at the plant and that happens all the time. They have poor maintenance on their products and their equipment. And so sometimes that can cause problems. And then we have the purchasing manager that may purchase low quality raw materials, resulting in unfavorable labor variances and efficiency variances for the production manager because they're not buying good quality products. And it may take a little longer, it may take more to get the job done. All right, so we have Hansen Inc. has the following direct labor standard to manufacture one zippy. So we have 1.5 standard hours per zippy at $12 per direct labor hour. And it says last week, 1,550 direct labor hours were worked at a total labor cost of $18,910 to make 1,000 zippies. So Hansen's labor rate for the week was the labor rate variance for the week was. All right, so we have to know how to calculate this out. So we have to look to see what was the actual hours that we had. We had 1,550 was our actual hours. And now let's look at the difference between the actual rate and the standard rate. So the standard rate was 12. So now we got to figure out what was the actual rate. Well, we had a total cost of $18,910. And we have to divide that by the direct labor hours that were worked, 1,550. So the actual was $12.20. So we have actual higher than what was estimated. So we know it's going to be unfavorable. So we're going to take the difference between the 12.2 that we just calculated and the 12 standard. So it's 20 cents. And then we're going to multiply it by our actual hours. That was 1,550. So we have 310 as an unfavorable balance. All right, so here's the calculation here. So it's showing you the 1220, doesn't tell you where that comes from. So you remember you got to calculate that out. It's just the total, 18,910 divided by 1,550. That's where the 1220 comes from. Then it wants to know the labor efficiency variance. So we're looking at the number of hours. So we need to look at what was the standard rate? The standard rate is $12. And then we got to take the difference between the actual hours and the standard hours. So the actual hours were 1,550. And then what was our standard hours? Well, we're making 1,000 zippies. So we take 1,000 and we multiply it by the standard rate of 1.5 hours per zippy. So it's 1,500. So the difference is 50 hours between the 1,550 and the 1,500. And then we multiply that by the 12. So we're here. We multiply that by the $12 standard rate and we get $600. Well, is the actual 1,550 total hours more than the standard of 1,500 hours? It is, it's more, which means the variance is going to be unfavorable because we had a little more hours on the job than what we estimated. So we have $600 unfavorable balance. Okay, and there's the calculation for it. Okay, so this is just kind of plugging it all in so you can see how we just calculated out the variance. All right, so now we're going to be looking at the manufacturing overhead rate and efficiency variance. All right, so we have Glacier Peak Outfitters uses the direct labor hours as the allocation base in its predetermined overhead rates. And the company has the following standard variable manufacturing overhead costs for each mountain parker. So we have 1.2 standard labor hours per parker at $4 per labor hour. Last month, employees actually worked 2,500 labor hours to make 2,000 parkers. Actual variable manufacturing overhead for the month was 10,500. Okay. So it's saying our actual hours are 2,500 that was given to us. It tells us the standard rate for dollars per hour on these two sections, right? We need the standard rate. So we got to calculate out this per hour for the actual rate. So it tells us that the we had 2,500 labor hours to make 2,000 parkers, and the variable manufacturing overhead was 10,005. So we're going to look at the total 10,005 divided by the 2,500. And that gives me my 4.2. Okay, so we're just taking that total 10,005, dividing it by the 2,500 labor hours to get the 4.2. And then we have the 2,500 times 4, which is given to us. It's 10,000. So we look to see, is the actual per hour lower or higher than the standard? Well, the estimate was 4. Actual comes in at 4.2. Well, we know that we're going to have an unfavorable balance. So we just take the difference, and that's $500, and it's unfavorable. Now we're going to look at this standard hours here to see what that is. So remember, it told us that we produced 2,000 parkers in this example. And it also told us that it was 1.2 labor hours. So we're going to multiply by the 1.2. That's how we came up, that's how we came up with the 2,400 hours. So we multiply them out and we look at our hours. So our standard hours that we're estimating is 2,400 and the actual is 2,500. Well, the actual is more, so it's unfavorable. So we take the difference of the 10 and the 9,600 and we get 400 unfavorable variance. Okay, and here's the calculations on how we just came up with those numbers. This is the other format that you can put it in if this is easier. All right, so now we're going to do one more quick check. So we have Hansen has the following variable manufacturing overhead standard to manufacture 1 zippy. So we have 1.5 standard labor hours per zippy at $3 per direct labor hour. Last week, 1,550 labor hours were worked to make 1,000 zippies, and 5,115 was spent for variable manufacturing overhead. So they want to know Hansen's rate variance for variable manufacturing overhead. All right, so we have to look at what were my actual hours. My actual hours are 1,550. Okay, and then I'm going to multiply that by the difference between the actual rate and the standard rate. So the actual rate, we have to look to see how do we calculate that. So we look at the total of the total that was spent was 5,115. That was what was given to us. And we have to divide it by the hours of 1,550 labor hours. So the actual is 3.3 direct labor hours. Well, what happened? What was our estimate? It was $3. So we know we're going to be unfavorable because we have a difference there of 30 cents. So that 30 cents is going to get multiplied by the 1,550, and it gives me 465. Sorry, wrong slide. 465 unfavorable. All right, so here's my actual hours. The difference is 30 cents, and I multiply it, so I get 465. If my actual is higher than my standard, then I know I'm unfavorable. So let's look at the efficiency variance for the variable manufacturing overhead. All right, so we have a standard rate of $3, which was given to us. And then we want to multiply that by the difference in the actual hours and the standard hours. So our actual hours given to us was 1550. We produced 1,000 zippies. So I need to multiply that by the 1.5 to get 1,500. So the difference between the 1,550 and the 1,500 is 50 hours. And then I have to multiply that by that standard rate of 3, which gives me $150. Well, if my actual hours are 1,550 and what I was estimating was 1,500, I'm over. So that's going to give me an unfavorable balance. So the difference is 150 and it's going to be unfavorable. So this is how we calculate that out. And then it tells you the 1,000 units times the 1.5 is how you get the 1,500. Okay. And then here it is all laid out for you. So here's my $3.30 that we calculated. This is the $3 standard given to us. The 1,550 is given to us. You have to calculate out the standard hours, which was the 1.5 times 1,000 Parkers. Okay, so we do the calculations. And when you look at it this way, you can see, okay, my actual is higher than my standard. So I know I'm unfavorable. Over here, I can look at, here's my hours, and I have an actual 1,550 hours versus 1,500 hours, then I can see, okay, this is unfavorable. So this is helpful if you're getting confused if it's favorable or unfavorable, to look at it that way. So the quantity variance is computed only on the quantity used, and the price variance is computed only on the entire quantity purchased. Oh, my mouse is giving me problems. Here we go. All right. So Glacier Peak Outfitters has the following direct material standard for the fiberfill in its mountain Parker. 1.5 per Parker at $5. Last month, 210 kilograms of fiberfill were purchased at a cost of $10.29. Glacier uses 200 kilograms to make 2,000 Parkers. All right, so we're looking at it broken out, and we calculated this number, this 490 out earlier. So we have the 210 that was given to us. We have the, let me see if it tells you how to calculate it. It does not. But what you have to do is look at the example in order to come up with this 490. And 1029 is what was spent. And you have to go back to see how much was purchased. So it was 210. So that's where the 490 comes from. The 1029 divided by the 210 to get the 490. And then the 200, you just have to calculate that out. It was going to be the 2,000 Parkers. And we were estimating 0.1 per Parker. So it's 200. Okay. So we have a price variance of 21, and it's favorable because that $4.90 is lower than the actual, the standard at $5. All right, so what are some advantages of standard cost? So it says that standard costs are a key element of the management by exception approach, and the standards can provide benchmarks that promote economy and efficiency. Standards can greatly simplify bookkeeping, and standards can support responsibility accounting systems. So they're saying that, you know, it could be good using the standard costs, especially when you're doing the bookkeeping, because then you have that rate that you're using throughout, and then you can compare at the end of a period and see what were those actual costs versus what were you estimating, and then you can make an entry at that point to clear off those variances. There's also some problems with using standard cost, and it's saying that variance reports are usually prepared on a monthly basis and may contain information that is outdated. So remember, we're always looking at stuff that's happened in, in the past. It's the only way you can evaluate it. It has to happen in order to look at it. And then if the variances are misused as a club to negatively reinforce employees, morale may suffer. Employees may make dysfunctional decisions. So, if you have people that are tied to some of these different bonuses or rewards, and things aren't working out because they're taking variances and just kind of throwing them someplace, numbers can look really bad, and then they never hit their rewards. That can be frustrating. So sometimes the morale goes down. And then we have labor variances. Assume that the production process is labor paced and that the labor is a variable cost. These assumptions are often invalid in today's automated manufacturing environment, where employees are essentially a fixed cost. Okay, and then we also have just meeting the standards may not be sufficient. Continuous improvement may be necessary to survive in a competitive environment. And then in some cases, a favorable variance can be as bad or worse than an unfavorable variance. And then we have excessive emphasis on meeting the standards. They may overshadow other important objectives, such as maintaining and improving quality, on-time delivery, and customer satisfaction. So you don't want to have those standards in place and then it jeopardize, the operations of the business. You want to make sure that you're still maintaining that customer satisfaction. You're not cutting corners with, lower quality product to save money. You have some managers that possibly are going to bring in equipment and pay those extra fees, to get it in quicker, to try to have the product there faster, which can cause costs to go up. So sometimes using that standard isn't always the best way to go. So anyway, so that is the end of chapter 10 and the end of the lectures for this semester. Do y'all have any questions on chapter 10?
No, I don't have any